Okay, Chapter 2, Debits and Credits, Analyzing and Recording Business Transactions. So this is a very, very important chapter. It's very important that you understand debits and credits. Some of it, especially at the beginning, may require some memorization. So important to memorize things and not take this chapter for granted is very important. And we will use debits and credits for the rest of your accounting career, however long that may be. Okay, so learning objective 2.1 is explain T accounts and how to foot and balance. So a standard account is a business transaction is recorded in the accounting equation under a specific account. Different accounts are used for each subdivision of the accounting equation. So assets, there's different accounts that are assets, like cash, things that you own. Liabilities are things you owe, OWE, to other companies. Equity is ownership of the company. We have expenses like payroll expense, advertising expense, rent expense, and we have revenues. There may be like consulting revenue or revenue from sales. Okay, so these are different categories. Assets, the accounts are cash, supplies, and different fixed assets, different things of that nature. Okay, so we're going to talk a little bit more about accounts. So needed, a way to record the increases and decreases in specific account categories, keeping them together in one place. So a standard account, a formal account that includes columns for date, item, posting reference, debits, and credits. Accounts have a separate form. Each form contains all transactions affecting it. All forms kept together in a ledger book-like. Each page contains one account. Okay, a standard account. So a standard account form is the source of the T account shape. So it looks like a T. You have your line across the top and then like a heavier line down the middle. And you have your debits on one side and your credits on the other side. Okay, so all T accounts have this structure. Left side is called the debit. Right side is called the credit. Debit and credit indicates position only. For some accounts, you will debit it to increase it. For other accounts, you credit it to increase it. So these are the rules of accounting that we will be learning about throughout this chapter, and very important to memorize and commit these things to memory. Okay, balancing account. The procedures used to balance an account is the same for all accounts. So this is the example of a T account, and maybe up above the one line you'd have cash, and this would be your type of account, and you have your debits on the left side and your credits on the right side and the date of the different transactions. But for cash, when you debit it, you're increasing the cash account. When you credit it, you're decreasing the account. So you got these different transactions. You have a transaction on April 2nd for $5,000 where you're increasing possibly cash, and then one on 4/20 where you're increasing cash $600. And then on 4/3, you decrease $400, and on 4/24/5, you decrease cash $500. If you add both sides of the column, you get your totals, and then you take whichever column is the highest. So you have the 5,600 and you have the 900. So your balance is, if you subtract those two, you're left with a debit balance in this account of $4,700. So this is called footing the account, where you find out what the ending resulting balance is, because you need to know what is the balance of each one of those accounts to complete your financial statements. Okay, so on the bottom, I think it's saying the same thing. Add the items listed on the left side and foot. Add the items listed on the right side and foot. Subtract the smaller number from the larger, the result of the account balance listed on the side with the larger amount. Okay, and that concludes Learning Objective 1.